Hey there, welcome to our video on the impact of rising interest rates on banks. Many are stressed about the recent issues with Silicon Valley Bank and Signature Bank. As interest rates continue to rise, it's important to understand how this affects the financial performance and balance sheets of banks. So let's dive in and explore the potential effects of these interest rate hikes. The first question is, how do banks make money? There are quite a few ways. First, there is interest income. Banks lend money to customers in the form of loans and charge interest on the amount borrowed. The interest charged is higher than the interest paid to depositors, allowing the bank to earn a profit. Second, fees and service charges. Banks charge fees for various services such as ATM usage, wire transfers, and overdrafts. These fees contribute to the bank's revenue. Third, investment income. Banks invest in stocks, bonds, and other financial instruments to earn a return on their investments. Fourth, credit card revenue. Banks earn revenue from credit card transactions. They charge interest on credit card balances and earn fees from merchants who accept credit card payments. Fifth, foreign exchange transactions. Banks earn money by facilitating foreign exchange transactions, such as converting one currency into another for customers. Overall, banks make money by charging interest on loans, fees for services, earning investment income, credit card revenue, and foreign exchange transactions. The largest source of income for a typical bank is interest income. Specifically, making money from the difference between interest earned and paid, which is called the spread. Banks use depositor funds for a variety of purposes, including making loans, investing in securities, and earning interest on reserves held with the central bank. When you deposit money into your bank account, the bank becomes a custodian of your funds and uses them to generate income. One of the primary ways banks earn money is by lending out deposits to borrowers at a higher interest rate than the rate paid to depositors. This is known as the spread or net interest margin. Banks also invest in securities, such as government bonds, to earn more income. Additionally, banks may hold on to some of their deposits as reserves with the central bank, which can also earn interest. Banks use depositor funds to make money for themselves while still supplying liquidity and credit to individuals and businesses. What are a bank's favorite investment securities? They typically favor investment securities that are considered safe and highly liquid. Government securities such as treasury bonds, bills, and notes are popular choices because they are low-risk investments with guaranteed returns. Municipal bonds, which are issued by local governments, are also a common choice as they offer tax-exempt income. Mortgage-backed securities, MBS, are another popular choice for banks because they provide a predictable cash flow and are backed by collateral in the form of mortgages. However, MBS also carries some risk and has been known to experience default in the past. In recent times, many banks have also begun investing in corporate bonds as they offer higher yields than government securities. However, these securities are usually riskier as they are not backed by the government. Ultimately, the choice of investment securities will depend on the bank's risk appetite, liquidity needs, and investment objectives. Considering these forms of investments and income, interest rates can impact all of it in a big way. Rising interest rates especially can pose several challenges for banks. One of the primary issues is that higher interest rates can lead to an increase in loan defaults. This is because borrowers may find it more difficult to repay their loans as the cost of borrowing increases, which can result in increased credit risk for banks. Additionally, rising interest rates can lead to a decline in demand for loans and mortgages, which can affect loan growth and profitability for banks. Another issue is that higher interest rates can increase funding costs for banks. Banks obtain funding from deposits, and when interest rates rise, they may need to offer higher rates to attract deposits. This can squeeze their net interest margin, which is the difference between the interest earned on loans and the interest paid on deposits. Moreover, rising interest rates may also lower the value of investment securities held by banks, such as bonds and notes, resulting in losses on the bank's financial statements. Overall, rising interest rates can have a significant impact on a bank's financial performance and may require them to adjust their lending and investment strategies accordingly. With recent events, we have not seen an increase in defaults. However, we have seen a significant drop in bond prices, which is not being seen in bank balance sheets, unless you are Silicon Valley Bank. Now that we have laid the foundation, what happened to Silicon Valley Bank? They encountered a liquidity crisis resulting from a combination of factors, namely higher interest rates, lower risk appetite, and deposit withdrawals. The bank's primary clients were tech startups that faced difficulty raising funds and going public due to rising interest rates. As a result, some of these clients withdrew money from SVB, which prompted the bank to sell its bond portfolio at a loss to meet redemptions. This, in turn, led to a capital shortfall. SVB attempted to raise more capital by selling stock, but the deal fell through as more clients withdrew their funds. As a result, SVB exhausted its funding options and was compelled to shut down by regulators. How does a larger bank's financial situation stack up to SVB? Let's have a look at Citi Bank. One of the largest banks in the U.S., is an expert in capital management. To ensure they are effectively managing their liquidity, they have key metrics in place such as CET1, Common Equity Tier 1, and SLR, Supplementary Leverage Ratio. These ratios measure the bank's financial strength and capital adequacy, providing insight into their ability to manage risks and absorb losses. As of December 31, 2022, Citibank's CET1 ratio is at an impressive 13%, surpassing the regulatory standard of 4%, while their SLR ratio is at 12.8%, exceeding the required 6%. Despite their stellar ratios, there is always a risk that must be considered, and for Citibank, it lies within their balance sheet. Specifically, it's the assets that back the deposits. These assets can range from specific stocks, ETFs, and bonds. So, while Citibank may be well managed and not at risk of capitulation, it's crucial to keep an eye on these underlying assets to assess potential risks. As such, it's important for any bank to manage their assets carefully and ensure they are appropriately diversified to minimize potential risks. We can assess this diversification from their balance sheet. In an environment where interest rates continue to rise, it's no secret that the bond market can suffer a significant blow, and this can have a ripple effect on other aspects of a bank's financials. But if you take a closer look at Citibank's investments, you may not see movement in the value of assets. How can this be? The answer lies in the accounting principles applied to available for sale, AFS, and held to maturity, HTM, assets. Essentially, any profit or loss incurred on these assets is not reflected in the profit and loss statement until it's sold. AFS is measured by market value, but any profits or losses are kept as other comprehensive income on the balance sheet. Meanwhile, HTM is measured using the amortization method, resulting in no losses or gains hitting the income statement. While this accounting method may seem confusing, it's important to understand that these unrealized gains or losses can add up over time, and if they're large enough, they could potentially cause a bank run. As such, it's crucial for banks to manage their assets carefully, diversify their portfolios, and stay abreast of market conditions to mitigate potential risks. While banks like Citibank may not be the first choice for investors, understanding these nuances of their financial reporting can help us better assess their overall financial health and make more informed decisions about our investments. For a breakdown of these unrealized gains and losses, you can extract tables from their latest 10K. You can see the unrealized losses due to the recent bond market moves are $6.7 billion, which is compared to $435 billion. That is only 1.5% of total investment in HTM and AFS. These losses will be realized if Citi is forced to sell them. But not a bank that is in trouble. Despite concerns about the stability of banks, there's actually less cause for alarm than many might think. The biggest risk for banks is a sudden loss of deposits, which can lead to serious financial trouble. However, it's worth noting that larger banks like Citibank are generally better equipped to manage capital requirements and other risks than smaller banks. That said, it's important to remain vigilant and keep an eye on potential warning signs. Smaller banks may struggle to keep adequate capital requirements and could be more vulnerable to sudden losses of deposits. But for now, it seems that the lights are still on, and that's certainly good news for investors and consumers alike. So, while there may be some risks and challenges on the horizon, it's important to stay informed and make smart decisions about our financial futures.